Hi everyone, I'm Jacqueline Gonzalez, and today I will be discussing and going over the company analysis report for Hormel Foods. Okay, so first thing here we have the selected financial information for Hormel Foods, which is set in thousands. So basically what happened was in fiscal year 2015, the company began actively marketing a portion of Diamond Crystal Brands, which is one of the companies that they acquired. And through this process, the company then identified the specific assets and liabilities to be sold, and then they allocated the goodwill based on the relative fair values of those assets held for sale and the assets that will be retained by the company. So after this, the company then had to determine that the carrying value of the DCB assets held for sale more than likely not exceeded its fair value, requiring a two-step for impairment, which then in turn brings us to them deciding to sell a portion of DCB, resulting in a goodwill impairment charge of $21.5 million. Next, we have a selection of 12 different line items that were pulled from Hormel Foods annual report for 2015. And here a trend series was created based off of that data. So here we can see that total liabilities were increased by 31% over a time period of 3 years. And that was the case even with the total assets increasing by 24% during that same time period. So we can see a pretty significant time jump between 2013 and 2015 for this trend series. Next up, I have a comparative analysis that was done between Hormel and one of its competitors, Conagra Foods. And here you can see, based off of these two line items that are highlighted here in red and green, we can see that although Hormel has less total assets, they do carry a 9% higher profit margin when comparing to Conagra. And here we can see again that although they do have significantly lower total assets within that 3-year time span, particularly in 2015, we can see that their profit margin is clearly a lot higher than that of Conagra. Okay, so here we have some basic information on Hormel Foods Board of Directors. Now, based off of this little table here, we can see that the board does indeed represent a diverse field of expertise. However, of these 15 individuals that are listed here, only 27% are female, as well as there only being 27% of different ethnicities other than white. A TOES analysis was done to determine the strengths, weaknesses, threats, and opportunities of Hormel Foods. So just to name out a few strengths, we have product innovation, barriers of market entry, veteran management team. Weaknesses, we have investments in R&D, tax structure. Threats, we have government regulations and raw material inflation. And some opportunities would be growth categories and emerging markets. Lastly, I composed a memo to send out to the chairman and CEO of Hormel Foods, Mr. Jeffrey Ettinger, pretty much letting him know of the summary of findings that I came across while doing this analysis on their 2015 annual report, as well as a few recommendations that I think could really be a strong driving force for the company. So here I would recommend that Hormel Foods should work on increasing revenues by making more investments in R&D to be able to comply with government regulations, which seems to be a pretty big problem. Long-term debt has been very steady over the last 3 years, but if revenues cannot be increased, then there is a strong possibility that profit could be damaged due to the interest expense from the $250,000 debt that they currently have. Lastly, I would recommend that the management team work on enhancing the company's growth profile by introducing a more diversified line of products that really capitalize on health and wellness, which could also really serve as a strong driving force against the competitive market. Well, that concludes my presentation, and I thank you all for watching.